Silver is sitting at $82 an ounce. That's 30% up from the recent bottom at $63.90. That's also 30% down from the $93 top. The market is in perfect equilibrium. Bulls got their rally. Bears got their correction. Everyone is comfortable. Everyone is watching the same charts. And while both sides argue about technical levels and moving averages, something broke underneath the surface that will not be repaired. The COMEX registered silver inventory just fell below 100 million ounces for the first time in modern tracking history. 98 million ounces left. Nearly 5 million ounces drained in a single day. March open interest sits at roughly 65,000 contracts. That represents 325 million ounces of paper claims against 98 million ounces of physical metal. The ratio just hit 3.3 to 1. First notice day is February 27th. 2 weeks away. This is not speculation. This is publicly available data from the COMEX itself. You can verify this number right now. And if you understand what that ratio means, you already know what happens next. Because this pattern has played out 3 times in recorded history. Same sequence, same breaking point, same catastrophic result. And it always ends the same way. Rome controlled the known world for 5 centuries. Legions stretched from Britain to Mesopotamia. The denarius was the reserve currency of the ancient economy. Pure silver coin that carried the empire's promise. But empires are expensive. Wars are expensive. Bureaucracies are expensive. By the 3rd century, Rome faced a choice. Raise taxes and trigger rebellion, or debase the currency and hide the theft. They chose debasement. The denarius went from 95% silver to 5% silver in less than a century. Soldiers were paid in worthless metal. Merchants refused imperial coin. Inflation consumed the middle class. The frontiers collapsed because legions could not be funded with fake money. By the time Diocletian tried to fix the currency in 284 AD, it was too late. The empire split. The West fell. The pattern was set. Verified. The Dutch Republic rose in the 17th century as the world's financial center. Amsterdam was the hub of global trade. The Bank of Amsterdam held gold and silver reserves that backed the guilder. Dutch ships carried goods across every ocean. The East India Company generated wealth that funded wars, infrastructure, art, science. But the Anglo-Dutch wars drained the treasury. Fighting the French drained more. By 1672, the Republic faced collapse. They needed funding. So they did what every empire does when the costs exceed the revenue. They suspended convertibility. The bank started issuing receipts without metal backing. For decades, no one checked. No one demanded physical delivery. The system ran on trust. Until 1790, when a financial crisis forced depositors to withdraw. The vaults were empty. The bank had been lending metal it did not have. The guilder collapsed. The Dutch Republic never recovered financial dominance. Britain took over as the world's reserve power within a generation. Same pattern. Same breaking point. Verified. Britain controlled a quarter of the Earth's land mass by 1914. The pound sterling was the global reserve currency. Every major transaction settled in London. But 2 world wars destroyed the balance sheet. Britain borrowed heavily from the United States. Promised to pay in gold. By 1945, the debt was unsustainable. Britain kept the pound pegged to gold through the Bretton Woods system, but the reserves were draining. Every year, more pounds were printed than gold held. By 1967, speculators knew the math did not work. They began shorting the pound and demanding physical delivery. Britain fought back with capital controls, interest rate hikes, international loans. None of it worked. On November 18, 1967, Britain devalued the pound by 14%. The reserve currency status was finished. The dollar took over. Same pattern, same sequence, same outcome. Verified. Now look at where we are. The United States national debt sits above $36 trillion. That number increases by 1 trillion roughly every 100 days. Debt to GDP ratio exceeds 130%. Interest payments alone now consume more than the defense budget. Social Security, Medicare, Medicaid are structural deficits with no political solution. The only way to service this debt is to print more currency. The Federal Reserve's balance sheet exploded from under 1 trillion in 2008 to over 9 trillion by 2022. They tried to reduce it. They failed. It is expanding again. Treasury issuance is accelerating. Foreign buyers are disappearing. China just reduced its holdings of U.S. treasuries, stocks, and bonds to $1.56 trillion. That is near the lowest level in 14 years. Excluding Belgium custodial accounts, which are widely understood to represent Chinese holdings, the total is down to $1.16 trillion, lowest since 2008. In November alone, China sold $6.1 billion in treasuries. And now, reports confirm China is urging its banks to begin selling U.S. treasuries altogether. This is not random. This is systematic deleveraging from dollar exposure while accumulating physical commodities and strategic materials. When the largest foreign creditor of the United States spends 14 years methodically exiting your debt, that is not portfolio rebalancing. That is preparation for a currency event. The World Uncertainty Index just surged past 2020 pandemic highs. It is now higher than the 2008 financial crisis. Measured uncertainty is at the highest level in modern data tracking. 9 large U.S. companies filed bankruptcy last week. Corporate bankruptcies are at the highest levels since COVID. Consumer debt defaults hit 4.8%. That is the highest in 8 years. Job openings are collapsing while unemployment begins ticking upward. The jobs-to-workers gap just turned negative, which historically leads to sharp increases in unemployment. And yet, gold is up 76% over the past year. Silver is up 150%. Copper hitting record highs. Crude oil holding gains. These are not signs of a healthy recovering economy. These are signs of currency debasement meeting structural supply shortages while the real economy deteriorates underneath. When commodities explode during economic contraction, that is not growth. That is monetary collapse being priced in by people who understand the cycle. We are not at the cliff. We have already walked off it. The only question now is how long the fall lasts before impact. And silver is the canary in the coal mine that just stopped singing. Here is what that means in the physical world. The Silver Institute just released their latest outlook. 6th consecutive year of structural deficit confirmed. The forecast deficit stands at 67 million ounces. That means global demand exceeds global supply by 67 million ounces this year. Investment demand surged 20% to 227 million ounces. That is a 3-year high. India alone is projected to import roughly 220 million ounces of silver this year. That is approximately 25% of total global annual mine production. One country is importing a quarter of all the silver mined on Earth. That is not investment speculation. That is physical offtake you can verify through documented customs data. Industrial demand is projected at 650 million ounces. Mine production is up 1% to 820 million ounces. Recycling jumped 7%, topping 200 million ounces for the first time since 2012. But even with increased mining and record recycling, demand still outpaces supply by 67 million ounces. 6th straight year of deficits. That is a cumulative drain on above-ground inventories that cannot be replaced. Every year, the world consumes more silver than it produces. Every year, the buffer gets smaller. Every year, the system gets closer to the breaking point. And now we arrive at the COMEX. Total registered silver just fell below 100 million ounces for the first time in modern tracking. Registered inventory now sits at 98 million ounces after 5 million ounces drained in a single day. 2.5 million withdrawn from JP Morgan alone. 1 million withdrawn from Loomis. March open interest sits at roughly 65,000 contracts. Each contract represents 5,000 ounces. That is 325 million ounces of paper claims against 98 million ounces of registered physical metal. The ratio just hit 3.3 to 1. That means for every ounce of actual silver sitting in COMEX vaults, there are more than 3 paper claims against it. February deliveries already exceeded 100% of open interest. If March follows anywhere near the same pattern, COMEX faces the largest physical delivery test in its modern history. First notice day is February 27th. That is 2 weeks away. On that date, contract holders can demand physical delivery. The exchange must either deliver metal, force cash settlement, or allow contracts to roll forward into May. But here's the problem. The Eastern physical markets are not playing along anymore. Shanghai silver markets were already in record backwardation before Chinese New Year. Backwardation means the front-month contract is trading at a premium to future months. That is the opposite of how commodity markets normally work. It signals immediate physical shortage. It means buyers are willing to pay more for silver today than silver 6 months from now because they need it now and they are not confident it will be available later. Short sellers on the Shanghai Metals Exchange are paying deferral fees just to avoid taking delivery. That is not normal market behavior. That is shortage mechanics. The sustained premium of Eastern physical silver over Western paper silver has now held above $6 per ounce. Normally, arbitrage closes price gaps immediately. Traders buy the cheaper market, sell the expensive market, and pocket the difference until prices converge. But that is not happening. The premium is not closing. That tells you something is broken in the delivery mechanism. Either there is not enough physical metal available to move from west to east, or the holders of physical metal in the West are refusing to sell at current prices because they know what is coming. Either explanation leads to the same conclusion. The paper price is fake. The physical price is real. And the gap is widening. Now we layer in the timing risk. The Shanghai Metals Exchange closes Sunday, February 15th, through Monday, February 23rd, for Chinese New Year. 8 days where the largest physical silver market in the world goes completely dark. No bids. No buying pressure. No Eastern support. Western banks know this. They have exploited this closure in the past. Check the historical price action during previous Shanghai holiday closures, and you will see the pattern. Prices get hammered during the blackout period when the physical buyers are offline. It is documented. It is predictable. And it is coming again in 3 days. Expect heavy paper selling. Expect technical breakdowns. Expect stop losses to get hunted. The 150 exponential moving average on the hourly chart was briefly reclaimed, then lost again. As of now, silver is trading below it, which means that level is acting as resistance, not support. For short-term traders, that is a bearish technical signal. It means structurally, on paper, silver could go lower during this window. And the banks will use that Shanghai closure to push as hard as they can without physical buyers absorbing the pressure. This is the manipulation window. This is where they try to shake out weak hands before March 1st notice day. But here is what is different this time. The physical shortage was already critical before the holiday. China was already in record backwardation. India was already importing a quarter of global supply. COMEX registered was already below 100 million ounces. The deficit was already in its 6th consecutive year. The March open interest was already sitting at 325 million ounces against 98 million registered. The setup is already in place. The 8-day closure does not fix the structural problem. It just delays the reckoning. And when Shanghai reopens on February 24th, 3 days before first notice day, the backwardation will still be there. The premium will still be there. The shortage will still be there. And the countdown to delivery will be 3 days away. Here is the choice the system faces. March contract holders can roll to May and avoid delivery. That kicks the problem down the road. Or they can stand for delivery and demand physical metal. If a significant percentage stands for delivery, COMEX will have to either produce metal from registered inventory, convince eligible inventory holders to move metal into registered, pay massive premiums to source metal from outside the system, or force cash settlement and admit they cannot deliver. Every one of those options breaks the illusion. If they deliver, registered inventory drains even further, and the next contract month faces an even worse ratio. If they source external metal at premium prices, it confirms the paper price is suppressed and physical is trading higher. If they force cash settlement, it confirms the system is fractional and cannot honor its contracts. There is no clean exit. The math does not work. The only reason it has not broken yet is because most contract holders have historically rolled or taken cash instead of demanding physical. But that behavior is changing. February deliveries exceeded 100% of open interest. That has never happened before. Physical demand is overwhelming the system. And March is bigger than February. Now we zoom out to the macro picture. Texas just announced they will produce their own gold and silver coins approved for IRA and 401k use for state residents. Initial batches will be commemorative, but future issuance is planned for large-scale retirement account access. Scottsdale Mint is involved in the production process. This is the first state to create its own precious metals coinage for retirement accounts, but it will not be the last. If Texas succeeds, Florida will follow. Wyoming will follow. Montana will follow. You are talking about tens of millions of retirement accounts suddenly having state-approved access to physical gold and silver within their tax-advantaged structures. That creates permanent institutional demand infrastructure at the state government level. It bypasses the federal system. It decentralizes monetary alternatives. And it IPOs precious metals to the masses in a way that has never existed before. When state governments begin minting their own money and embedding it into retirement account infrastructure, that is not a fringe movement. That is systemic preparation for currency failure. Ray Dalio wrote in Principles for Navigating Big Debt Crises about how debt cycles end. They do not end with sudden collapse. They end with currency devaluation that makes the debt serviceable in nominal terms while destroying purchasing power for everyone holding that currency. You print your way out. You debase your way out. The debt gets paid, but the money becomes worthless. That is the pattern. That is the only politically viable solution when the debt cannot be repaid in real terms. And we are watching that playbook unfold in real time. The Federal Reserve will continue printing. The Treasury will continue issuing. Foreign buyers will continue selling. And the currency will continue losing purchasing power against hard assets. Gold, silver, land, energy, food. Anything that cannot be printed. Jesse Livermore wrote in Reminiscences of a Stock Operator about recognizing the difference between a true bull market and a temporary rally inside a bear market. He said the real money is made in the big swing, not in daily price noise. Most traders lose by chasing every move. Those who build generational wealth recognize structural shifts early, position themselves, and hold through volatility until the trend is complete. That is where we are now. A multi-year silver deficit, draining COMEX inventories, rising Eastern physical premiums, geopolitical moves away from dollar assets, and expanding state-level precious metal systems are creating a classic big swing setup. This is not a short-term trade. It is a structural transfer of wealth from paper claims to physical assets. Most people will miss it because they wait for comfortable confirmation that only appears after the opportunity is gone. If this breaks in the real world, the effects will be immediate. Grocery prices double in weeks, not years. ATMs go offline. Brokerage accounts freeze. Banks impose withdrawal limits. Retirement balances look fine on paper, but buy less every day. You still have numbers on a screen, but real purchasing power disappears. Everything is being repriced in real time. Everything is negotiable. And the people who prepared early, who moved wealth into physical assets before the break, are the only ones who will retain real purchasing power. This is not theory. It is pattern recognition. Rome, the Netherlands, Britain, same cycle, same breaking point, same outcome. Currency collapse never announces itself. It happens slowly, then all at once. And by the time it becomes obvious, the window to prepare is already closed. Today, we are watching the same pattern unfold. Physical shortages are growing while paper supply keeps expanding. Price suppression continues, just as it has in precious metals for decades. But it only works until the divergence becomes impossible to hide. When it breaks violently. Recent silver market activity proves this disconnect. ETF selling pushed prices lower, stop losses were triggered, and contracts were settled cheaply. Yet physical demand surged immediately. Lower prices did not reduce buying. They increased it. Investors used the dip to secure real metal. That tells you everything. The paper market and the physical market are no longer aligned. Banks can roll contracts, delay delivery, and enforce cash settlement, but pressure continues to build. This is not hype. This is data. Rising uncertainty, shrinking inventories, sustained premiums, and structural deficits all point in one direction. In times like this, capital flows into hard assets, not for speculation, but for survival.